Welcome, guys. Alan here from Mount Martha Accountants, and I just wanted to have a little bit of a talk to you about rental properties, and in particular, renting out your holiday house or family holiday house. And what we're seeing, or what I've seen, even I'm not that old of a guy, but in my time in practice, what I've seen is a big increase in people renting out their family holiday home. And I think a lot of that is platforms like Airbnb and so many other online web-based platforms, and the fact consumers, so happy to rent a holiday house online these days makes it very easy to rent your holiday house. And of course, what that means is, potentially that income that you earn, you need to put that on your tax return, and potentially then you can claim, repairs, new couch, mortgage interest, all this sort of stuff. And potentially, depending on your holiday home, these claims could be very, very large and could result in what we call negative gear. So, the expenses of the rental or the holiday home are greater than the income that you earn, in which case it's what we call negatively geared, or commonly called negatively geared. That loss then will offset other income potentially on your tax return, may result in a savings of tax or tax refund. So that's great, but we need to be careful. There are quite a few situations that happen with rental property that we need to be aware of. The thing is, the tax law is quite clear actually that if something is private in nature, you can't claim a tax deduction. And this is where you get the issue, because holiday home, a lot of cases, it's going to be private in nature, at least to some degree, because you're going there and you're enjoying it with your family. This is the definition of private in nature. So, that they're the situations where you've got to be careful and go, well, hang on, I'm blocking out on Airbnb because I want to go at Christmas for a couple of weeks. I want to go at Easter for a week. I want to go Cup weekend. I want to go Straight A weekend. Well, hang on. Now, you're using that holiday home 4 or 5 weeks of the year, so you need to allow for that private use on your tax return. And I mean, potentially, even like some clients, they might, for example, block out every school holiday for themselves and then only rent it when it's not school holidays. Well, hang on, you're renting it to yourself, or you're using it yourself in every prime time of the year, and you're only renting it on these really B and C grade times when people don't want to come. You might have an issue if you're doing something like that. The other thing people will do is they go, oh no, I rented it. I got a new holiday house, and I rented it to my brother. He rented it for 2 weeks at Christmas. It's like, that's not really renting it out. To be renting it out, you need to have it listed with an agent. It needs to be at a proper price. You need to be pursuing tenants, trying to make money off the property. You can't rent it out every now and then, and still claim this big tax deduction. And unfortunately, that is what is happening with some clients' tax returns, and maybe they're not getting good information from their tax agent, or they're not giving the tax agent all the information to really complete that return right, and that is leading to issues in audit. And the tax office has been auditing holiday homes very heavily last couple of years, and they're still focusing on that area. They've seen, just like me, big increase in these holiday rentals, and found there's a lot of issues in the associated tax returns, and way clients are treating the holiday homes on their tax returns. So, look, it is important to get it right. You don't want to have an audit and have it go wrong. It's very expensive and obviously stressful. So, if you'd like a professional opinion, we'd love to meet you and go through it in more detail. Thanks, guys.